In this presentation, I will walk through the essentials to insurance accounting. At the conclusion of this presentation, you will have a fundamental understanding of insurance accounting. So this will be a high-level overview of the topic. I will not delve too much into the granular details of some of the topics that we cover. In this presentation, I will be covering the following subjects: the development of specialized accounting rules, insurance basics, financial statements, asset valuation, liabilities and reserves, and revenues, expenses, and profits. Okay, to kick off, I will begin by discussing the development of specialized accounting rules. Insurance companies falls within the environment of companies that are subjected to a fiduciary responsibility to the public. So this requires enhanced reporting requirements in addition to the SEC reporting. They are also subjected to statutory reporting to states' regulating bodies. Insurance companies are subjected to two accounting standards, that is US GAAP and statutory accounting principles. US GAAP applies to SEC reporting. It is used by end users who are decision makers, and mostly investors, who generally want to gauge a company's profitability. So there is a profitability focus and there is a going concern assumption, which essentially means that the investors are assuming that the business will continue operations going forward into the foreseeable future. As a result of this, there is an income statement focus. Under statutory accounting principles, there is more of a solvency focus. The reason for this is that state regulators are more interested in seeing an insurance company's ability to meet their debt obligations. So how solvent is an insurance company? That's what they're trying to understand. As a result of this, there is more of a balance sheet focus. I will now discuss a little bit about insurance fundamentals. So what is insurance and what do insurance companies do? Well, essentially, insurance is the management of risk in exchange for premiums. Now, insurance companies at the outset of an insurance contract, of an insurance policy, establishes the premiums that they will receive. And these premiums are paid and received prior to the expenses and the claims that will go out. So, insurance companies have to establish and set these premium rates without actual knowledge of what the actual claims and expenses that will be coming in. So, insurance companies have to rely on historical data to estimate what their premium should be. The insurance industry can be broken up into two major segments. That is the property and casualty segment and life and health segment. These two different segments will require the application of differing accounting rules due to the fact that there is a difference between contract durations and claim variability between the two segments. I'm going to delve a little bit deeper into these drivers of the differences into the accounting rules that are applied to these two major insurance segments now. So, contract duration. What is the difference between property and casualty and life and health segments? Well, property and casualty insurance policies generally falls under the scope of short duration contracts. So property and casualty insurance, which is mostly your auto, home, and business insurance, generally are for fixed periods within 6 months to 1 year. In contrast to this, life and health insurance, which is your health, dental, annuities, what have you, can be enforced for decades. The other main driver of the differences in accounting rules is the fact that property and casualty can have a lot more variability with their claims. They are more subjected to the risk of loss, catastrophic loss, so huge spikes in claims. And in contrast, life and health insurers generally are not subjected to this risk at any great degree. There has been only a few times in history where there have been catastrophic losses that have impacted a life and health insurer. A catastrophic loss may be the result of natural disasters or man-made disasters, such as a hurricane, flooding, or a terrorist attack. We'll now talk a little bit about the financial statements for insurance companies. Now, financial statements for insurance companies are lengthy and detailed documents. Under statutory reporting requirements, the opening section includes the balance sheet, the income statement, and capital and surplus account. And this is where it differs from U.S. GAAP. Capital and surplus account is statutory accounting principles concept. So what is the policyholder surplus? Well, the policyholder surplus is the statutory accounting principles equivalent to equity. It's not exactly the same, but it is the equivalent. So you can get to your policyholder surplus by taking the difference between assets and liabilities. So assets minus liabilities will give you your policyholder surplus. Now the policyholder surplus serves as an financial cushion to insurance companies and is also the source for expansion of insurance companies. Statutory regulators require a certain degree of and a certain amount of policyholder surplus based on the amount of risk that an insurance company takes on. I will now discuss some of the asset holdings of an insurance company. Some of the major assets held by an insurance company includes your high quality government and corporate bonds, your preferred and common stock, your non-admitted assets, real estate and mortgages, and your reinsurance recoverables. Okay, so high quality government bonds and corporate bonds. This is generally your bread and butter for an insurance company. This is the largest asset held by insurance companies. And insurance companies hold this because they must meet their asset liability management and liquidity needs. There is a difference in the valuation of bonds between statutory accounting principles and U.S. GAAP. Under statutory accounting principles, bonds must be valued at amortized cost. Under U.S. GAAP, bonds may be valued at either fair value or amortized cost, depending on whether it meets certain criteria. The next major asset class we will discuss are preferred and common stocks. Now for property and casualty companies, this is generally the second largest asset holdings. They hold a relatively larger percentage of their assets in this class preferred in common stocks compared to life and health insurance companies who hold relatively a lesser percentage. And the reason for this is just simply that this asset class better fits the asset liability and liquidity needs of an property and casualty insurance company. The next asset I want to discuss are non-admitted assets. Now, non-admitted assets are assets that are valued at zero. It's a statutory accounting principle concept. And the reason that these assets are valued at zero is because under statutory accounting principles has very high level of conservatism. So certain assets that are less liquid are deemed not allowed, so they're valued at zero. And some assets that are categorized as non-admitted includes premiums that are past 90 days due and your office furniture. The next major asset holdings of insurance companies are real estate and mortgages. So, real estate and mortgages are generally held in a higher percentage by life and health insurance companies. And the reason for this is that it simply meets their asset liability management and liquidity needs better than for a property and casualty insurer. A life and health insurance company has long duration contracts versus property and casualty insurer who generally have short duration contracts. So real estate and mortgages are generally fit better into the dimension of long duration contracts. The final asset that I will discuss is reinsurance recoverables. Now, reinsurance is essentially insurance taken out on insurance by insurance companies. So an insurance company may decide that they've taken on too much risk and they want to manage some of it away. So they will engage an reinsurance company to manage some of that risk and in exchange for premiums paid to that reinsurer. Reinsurance collectibles that are deemed unrecoverable are recorded under surplus as a penalty. I will now discuss an insurance company's liabilities and reserves. An insurance company's liabilities can be broken up into two components, and this is your reserves for policyholder benefit obligations and your claims by other creditors. An insurance company's reserves for policyholder benefits is by far their greatest liability. Reserve funds for the policyholder obligations include your unearned premium reserves, or UPR, loss and loss adjustment reserves, future policy benefits, which is a long duration contract concept, and your catch-all category, other. The unearned premium reserves refers to your premiums that have been collected but have not been earned yet. So this is your paid in advance premiums and your premiums that have not been matched to the work performed. So your UPR will be recognized over the course of the contract. Loss and loss adjustment reserves category refers to your claims that have been incurred but not yet paid. So this also includes your IBNR, incurred but not reported claims, claims that have occurred but you have not received the claim yet. This is an estimated cost, and all reserves are estimated to a degree. Your future policy benefits are it is a long duration contract concept, and it refers to the future benefits that will be paid out discounted to the present value, less the discounted value of the premiums that will be collected. This is another reserve that must be accounted for. We will now discuss an insurance company's revenue, expenses, and profits, which are income statement items. So an insurance company has two main sources of revenue. This is underwriting, which is insurance company's operations, and is investment results. An insurance company's main source of revenue is their policy premiums. The second source of revenue is their investment results. So the spread that they generate from their investments will be their profits, generating their profits. The premiums are recognized differently between your short duration contract compared to your long duration contract. And the reason for this is your short duration contracts are more estimatable. You know on the period of time that the short duration contract is going to cover, as opposed to your long duration contract where you don't necessarily know when it's going to end, when the policy is going to complete and be finished. So for that reason, premiums for a short duration contract are recognized evenly across the period of the contract. Premiums under long duration contracts are recognized as they are due. Policyholder benefits and claims is the major expense of insurance company. This is generally the largest recurring expense for an insurance company. So claims are recognized as they are incurred by the insurance company. So it doesn't matter whether the claims have been submitted. If the event has occurred, the insurance company recognizes those claims, and that is going to be an estimate. So that is your claims due to IBNR, incurred but not reported. You will also record your changes in reserves in the period where the change in reserve occur, and your changes in reserves will occur due to changes in your estimates. Acquisition cost is the last major expense that I will cover in this presentation. So acquisition cost is your cost to acquire the contracts, and how acquisition cost is treated differs between US GAAP and statutory accounting principles. Under US GAAP, an insurance company is allowed to or must capitalize the acquisition cost and charge it over the period of benefit. So this is referred to the matching principle under US GAAP. You match expenses to revenue. Since statutory accounting principles has a solvency focus and it's more conservative, the acquisition costs must be expensed immediately, and this is going to cause a mismatch of expenses and revenue. Okay, well that completes my presentation regarding the essentials to insurance accounting. Thank you so much for joining me.